This is the second time that we've tried this, and we hope that it's going to become a more regular occurrence if shareholders find it useful and interesting. But any ideas you have in terms of what you'd like to see done differently would be very welcome. So the general idea is to give you a bit more of an insight into what we invest in on your behalf and how we do it. And before introducing you to the companies, we thought we'd give you a day in the life of Amati. So just before going into what we do on a day-to-day basis, I think it's worth pointing out that we think of a VCT fund as two discrete portfolios. There's the qualifying portfolio, where we have to invest in companies that meet the rules set down by HMRC in terms of the size, the number of employees, and the nature of the trade. And then there's the non-qualifying portfolio, where we're more or less unrestricted in what we can invest in. And we choose to use the non-qualifying portfolio to invest in larger, more liquid businesses to give the overall portfolio, to de-risk the overall portfolio. And the other thing to point out is that it's quite a big universe of companies. So the way that we manage the VCTs is to split responsibilities up by sectors. And I think that does two things. First of all, it gives us as fund managers greater knowledge of particular sectors and industries. And secondly, when we want to include a new position in the fund, we have to convince our other two colleagues. And they will always come from an initial position of skepticism. So that could be quite a powerful process. So these are the main day-to-day responsibilities. First of all, there's portfolio management, so looking after what we already have in the portfolios. Then there's research, looking for new ideas. Once we've identified some interesting new ideas, there's the detailed due diligence we do before we decide whether to include the company or not in the portfolio. Then we also do private company deals, and the process for investing in a private company is somewhat different to investing in a listed company. And then we have reporting requirements as venture capital trust. These are independently listed companies in their own rights with independent boards and large groups of shareholders that we have to report to. And then there's marketing and shareholder communications. So with portfolio management, on a day-to-day basis, there are various means of monitoring what's going on in the portfolio companies. And the first one is announcements, stock market announcements. So these tend to come out first thing in the morning. So when we get to our desks, the first thing we'll look at is our portfolios, the pricing, and whether any of our companies have made any announcements. And companies will make announcements on a periodic basis when they have results. But also if they have something interesting to say to the market, they'll make an announcement. At the same time, we'll be taking phone calls from the sell side, from brokers, who will be pointing these announcements out to us and will be giving us their views on how a particular announcement affects the investment case for a stock and perhaps the expectation of future profits of that stock. And such announcements may lead to profit upgrades or downgrades, which will, of course, affect the price. Then we'll be discussing, the three of us, the three fund managers, sit at a desk together. So we'll be discussing the implications of these announcements on our portfolio companies and whether we have to take any action, whether that's to add to a position, to reduce a position, or indeed to sell out of something altogether. And then we have these results meetings with the companies that have reported, and we'll certainly meet all of our portfolio companies twice a year, but usually be speaking to them in between those times. So, Richard, we probably speak every couple of months or something like that. So, as well as monitoring what's in the portfolio already, we always need to research new ideas. And I mentioned at the start that we think of a VCT as two discrete portfolios, and in terms of finding new ideas, it's a very different process in the non-qualifying portfolio to the qualifying portfolio. In the non-qualifying portfolio, we have a universe of about 1,400 stocks, and that's every UK listed company with a market cap up to £2 billion. So there are three ways that we reduce that pool of companies. The first is by screening, and we have software that we can use to screen for certain quality indicators, whether it's growth or cash conversion or balance sheet strength. Then we have ideas from the brokers, who have lots of clever analysts working for them, who will come up with ideas which will be communicated to us. And then there's our market knowledge. So just through, all of us have been investing in smaller companies for quite a long time now. So there'll be we may believe there are particular companies that merit a closer look at any particular time. And then we have in terms of looking for qualifying deals, it's somewhat different. A qualifying deal can only be in a company that's raising new capital. So the way that we find these ideas is through our broker contacts. So they will get in touch with us and tell us they're raising money for a company. And we also find some ideas through our network, so such as places like Cambridge, where we have networks of advisors and industry specialists who will be pointing out companies to us. So once we've found the ideas that we want to spend more time on, we then go into more detailed due diligence. And the first thing is a management meeting, which is obviously we think is key to getting under the skin of a company. We'll often do site visits. That's a marble mine in Kosovo that Paul visited before we ultimately invested in that company. And that gives you a really good opportunity to meet the people who aren't necessarily city-facing, so people other than the chief exec and the finance director, who will often have insightful things to say about the company and perhaps haven't been as well briefed and polished as the senior management team. And then we have documentation review, so that's documents that are in the public domain, documents that we'll do our own desktop review. We may even commission independent people to do some research, some due diligence for us. And then we have these, what we call expert networks, which is really just an informal network of people that have a particular industry specialism who can give us a view on a company or a technology or a product. And all of this goes into what we call Amati Connex, which is our proprietary database and is really a database for all of our due diligence and all of our subsequent review and management of our holdings. Then private company deals, as I mentioned, the process for investing in private companies is somewhat different to public companies. First of all, we have to source these businesses. We have to structure and negotiate a deal with these companies. And we tend to invest in private companies using an instrument called a convertible bond rather than an equity instrument. And what that means is that if the company doesn't float as we expect and hope it will do, then that's a debt instrument that becomes repayable at a certain point in time. And if the company does float or exit, as we hope and expect it will, then we convert that loan into equity. And in the meantime, whilst we're holding that debt instrument, we take a yield on it. And with due diligence, there's less due diligence coming to us through the broker for these private company deals. So we have to do much more intense due diligence ourselves. We may be more inclined to commission independent due diligence. Then we have to look after the legals. And then after we've made the investment in a private company, we'll either take a seat on the board or we'll certainly reserve the right to take a seat on the board because they don't have the same reporting requirements as a public company. This is how we stay closer to them. And then we have reporting to you, the shareholders, and to the independent board, and that's through monthly fact sheets. We meet with the board on a quarterly basis, interim and annual accounts. And then we have meetings like shareholder communications and marketing, where we try and get in touch with intermediaries, for example, who look after their clients' VCT investments to keep them updated about what's going on. And this is the result. So we take 1,400 non-qualifying companies and perhaps 100 to 150 qualifying opportunities a year, and we filter through research and due diligence and analyst meetings and management meetings into 59 companies. Thereabouts currently in Amati VCT and approximately 60 companies in Amati VCT2. So I think the best way of bringing this all to life is to introduce you to our first company. And Ubisense is a business base that many of you may know, based right here in Cambridge. We invested in Ubisense when it was still a private business, just before it floated. And then we followed our money and made another investment when it listed. I think it's a wonderful example of a UK technology business. So to tell you more, we have Richard Green from Ubisense.